Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 13th of July, Bull versus Bear webinar here. Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go through our usual regular run through, take a look at the calendar, what we've had, what we've got coming up, taking a look at articles for the major news wires. What are those macroeconomic, fundamental, geopolitical, central bank data factors that are impacting financial markets right here, right now, and then take a quick look at the charts. Where are the potential trigger points on the charts on the markets that you guys are trading? Okay, first of all, heads up in here. Put this up after the CPI report yesterday. It's in the trading room under the fundamental reports. It's on the public site, that's tradeday.com, under the advice and tips, the blog tab. And I also posted it into the forums. So basically, CPI surprised better than expected. So continuing to cool lower. So the numbers are all better in here than expected. Just to quickly go through those in here. So where are we? US CPI, 3% from 4% in May, and that was after a sharp decline to 3.1. That's forecasts. And the core CPI was 4.8 from 5.3, with consensus at 5. So beating consensus and dropping from previously on both the core and the headline. Net result is, basically here we have the various inflation gauges coming down, and then likely the Fed will be less hawkish, de facto more dovish. And then we will then look at bond yields. We're going to look into this a bit more, but bond yields having spiked higher over the last week and a half, now moving significantly lower. And then the US dollar index in here completing their breakout in here and continuing to the upside. Both a little focus here on the S&P and the NASDAQ. So upside risks in here on the intermediate term, short to intermediate term outlook. So building a base for a strong second half of the year potentially. So what do we have yesterday? Well, yesterday obviously it was all about CPI. I've already run through those numbers. I'm not going to do that again. There they are there. We also had the Bank of Canada hiked as anticipated. And then overnight in here, just of note in here, we had China export data, which was worse than expected. Okay, China trade data, imports and exports down more than expected. Normally that would be a negative in here, but because of the overwhelming positivity coming through from the CPI numbers, this has largely been ignored, and we'll come to that shortly in here. So largely been ignored. Well, here's the article in here. So look, China's exports fall most in 3 years as the global economy falters. But, that should be a negative for all stock indices today. But you know what? Markets kind of like, who cares? CPI was better than expected. The Fed are going to be more dovish. Risk on. And we're staying in risk on mode despite this data. And then when we come to, actually, I'll jump to the Asia data. Look at the Asia. I mean, Hang Seng's up 2.6%. That's a reflection of the Chinese stock market. It's up in the face of that very negative Chinese data. The biggest fall in exports for 3 years, and worse than expected as well, as you can see, like in red. So all of that very negative, but the impact on markets. So this is a classic, right? The news is negative, the market reacts positive to other news that shows the market's got an underlying bullishness because it's completely ignored this what would normally be quite bearish news in here. Going into this morning, we've had some data out of the UK. GDP data slightly better than expected. Industrial production data kind of slightly worse, and manufacturing production data slightly better. So kind of mixed bag out of the UK. French inflation data this morning, bang in line. Look, you can see all in black in here, bang in line with expectations. Going into the US this afternoon, I will continue talking about CPI in a minute, guys, actually, but just get through the data. PPI this afternoon, a very, very much not the ugly sister, the poor cousin. Let's call it the poor cousin. PPI, definitely the poor cousin of CPI. I mean, it rarely moves markets. It has to be massively out of line, particularly after the big piece of data we had yesterday and how well the market has reacted. I do not see PPI having a big effect. Jobless claims rarely has a big impact, so don't worry too much about these, but we do have them also coming today. And we get Waller speaking later today. Whilst I'm on Waller, I just want to mention we are about to enter the Fed's blackout period. Remember in here, if I got the right year on this now, I always get the wrong year. Why have they got they're 2022 up here previously. I know they got rid of that, 2023 now. So here we are. So here's the next meeting, July of this year, in a couple of weeks' time. Well, just under 2 weeks' time in here. There we are now, the 13th. Remember, the Fed go on blackout the 2 weekends before the meeting. Okay, so it's actually from this Saturday. So today and tomorrow are the last times we're going to hear Fed speakers speak. So that's to bear in mind as well. Any Fed speakers in the next couple of days, maybe listen to what they've got to say, because we just had that CPI data. So it's going to be super interesting. And then we're going to get nothing, right? So we've had that CPI data. So really watching out for what these Fed speakers say in the next couple of days, given that now we have the CPI data out. The other thing to bear in mind as well is we're about to enter earnings season. So we've had PepsiCo, which beat expectations already this morning from Pepsi. But really, we kick off the big ones start off from Friday when we get tomorrow. We get we get JP Morgan, Wells Fargo. Usually, it's the financials, the banks. So JP Morgan, Wells Fargo, BlackRock, Citigroup, State Street, all reporting, and United Health tomorrow. So watching out for earnings season kicking off tomorrow. Let's run through 5 things to start your day. Well, obviously the focus on the CPI data, the dollar down on that. Why is the dollar down? Because we're expecting a more dovish Fed, a less hawkish, de facto, more dovish Fed equals weaker dollar, because interest rates are not as high, so it's less attractive to own dollars. Okay, so we're seeing dollar down. Okay, so dollar has been smashed on the downside in here across the foreign exchange board. That helps commodities as well, right? So oil's up anyway because of the anticipation of a less hawkish Fed, but oil's also up on the fact that the dollar's down. Because the oil is quoted in dollars, so a lower dollar equals a stronger oil price. And then similarly with gold up as well. Dollar and oil down yesterday, dollar getting hit on the downside because we're expecting other central banks, particularly the euro and the ECB, sorry, the ECB and the euro, and then the Bank of England and the pound to stay strong because they're still expected to be more hawkish now than the Fed. The Fed are getting close to, look, US interest rates near a peak. Okay, so hence the dollar down. What else we have in here for you? Elizabeth Warren, Senator Elizabeth Warren calling Feds to halt rate increases. But, who cares? She doesn't have any say in that. So, kind of big deal, right? What else do we have? China exports, we've already mentioned that in here. Market's kind of slightly up in here this morning, but slight dip, but I mean slightly up on the index side, and talking about the data that I've already gone through. So the big really moved. I know you guys are focusing on the equity markets, but the bond in here continue to go to higher prices, lower yields. Let's go jump to the bond chart. Look at this. We've been up. This tells you all you need to know, really, where the anticipation has been coming, that we're going to be lower yields, okay, and a less hawkish Fed. Look, bond prices going up, higher bond prices equals lower yields. There's the bond prices. Here are the bond. Eventually, I'll get there. Here are where have I moved it to? There it is. Here are the bond yields. Bond yields. Remember, we did the breakout. This is the 10-year. Let me just pop this a bit bigger. So the 10-year broke out at the top end of this range, right? It's been in this broader range in here. Okay, so we've got this narrower range and this broader range. So it popped out of this narrower range. It popped out the top of the range to the upper end of the bigger range on the 10-year. But look now, going back down into the old range in here, the old shorter term range. And back, not in the middle of this bigger range, but getting close. The middle of this bigger range is what? We're 430 down to really 330. So it's like 380. We're not far above the top of that middle of that range. Okay. So getting very close to the middle of the bigger range we've been in, having been up towards the upper end of that range only at the end of last week. So the big move has really been bonds. The bonds rallying equals lower yields, remember, because of slowing in US inflation and because of lower yields. Okay. And it's not only in the US, by the way. German bonds, bunds, and UK gilt also going down in bond yields something. So going down, the yields going lower as well for those countries. Futures pointing higher out of Reuters. What else do I have for you? Already covered that in here. Stocks extend rally, risk on mood. So we're in risk on, right? Dollar down, oil up. Gold is usually seen as a safe haven, but at the moment it's doing the opposite to the dollar. So we're seeing gold up with the dollar down. Dollar down and bonds rallying in here as we come out of this inflationary pressures. Inflation at 3% flags end of emergency, a turning point for the Fed. Fund titans are betting for everything against the dollar. So looking for all currencies, the dollar's getting hit everywhere, and all the funds pointing to that as well with their investments. China tech stocks doing well, being helped in here. So despite the negative China trade data, the Hang Seng Tech Index for the best week of this year. So a rebound in tech driving Chinese stocks higher in here despite the negativity, and also being helped by lots of talk about official support, about either monetary policy easing or help for the housing market or various other help support for the Chinese economy being talked about, and oil up, we've already mentioned that as well, on easing US inflation. What else do I have in here? So yeah, overnight in here, the Nikkei was up, on the back of US up yesterday, 1.5%. Hang Seng echoing China, 2.6%. European exchanges were up yesterday and further up this morning. 0.4 nearly for the FTSE UK. DAX up over 0.5%, up over 0.75% for the French CAC. And US indices obviously had a healthy day yesterday and following through this morning. Look, the Nasdaq up nearly 0.7. A quick nod to the Fed Watch tool in here. Now, no real change in here for the next meeting. Still looking for the hike. That's sitting way above 90 and is staying there. But if we go and take a look at the end of year now, look at how this has collapsed. Remember, we've been looking at this side. So this is the 25 up, right? This is up 25, which we're expecting in July. But now for the end of the year, the 13th of deck meeting, this was the addition of these two columns here was up at over 30%. Now 16%. Only 16% chance of another hike. More chance that we're going to cut rates between after we've hiked rates. So one more hike, then more chance of a cut now than a hike. Right, quick nod, and it will be quick nod, so it's going to be a fairly rapid, but we've already looked at bonds up, so that's the 10-year, 30-year up as well. Bonds up across the board in here, 5-year there and 2-year as well. All signaling reversal patterns as well. Look, 2-year in here. Look at that 13-period exponential moving average on the 2-year note, okay? So this is short end interest rates. Reversed that yesterday, right? Big and continuing up today in here. And similar bullishness here. Look, 5-year through it as well. The same 13-period exponential moving average. Reversal patterns across the board in here on the bonds. Quick nod to oil and gold. Oil continues up. We spoke about that peak. Took that peak out yesterday. Bigger basing pattern, all risk higher, sitting just below yesterday's highs in here. Still looks bullish for me for oil. Let's take a look at gold, and we're going to have a quick look at the dollar. Look at the dollar. I mean, smashed yesterday, absolutely smashed, and breaking. This is the dollar index, breaking below the lows in here that we last saw. Back here, where are we on these lows in here? This is from April, middle of April. Okay, so a massive fall yesterday and like absolute plunge over the last week in here on the dollar, and that's obviously helping gold here. So we go take a look at gold. Gold up. Normally gold's safe haven. So why is it going up in risk on? Normally it goes down in risk on. Well, it's going up because of the dollar weakness, and gold is quoted in dollars. Let's go to the markets that you trade in here. Oops, going back to the same one on the equity indices. I'm going to have nothing to say apart from bullish. I went into yesterday bullish. I said, we look bullish. We made new highs here on the S&P. We're making new highs this morning. I don't see it doing much other than going still higher in here. Look, it had a strong rally. We did get a notable setback in here yesterday afternoon after the open, but then since then a strong rally in here. So, and back up to new highs. Similar story on the Nasdaq in here. Nasdaq breaking above not only just the more recent highs from last week, but also the highs in here back from June, and then building on that again this morning. Look at the 15-minute chart, similar in here with the initial boost and then down and up again, and then continuing up and up and up and up. So looking really strong. Did you already cover natural gas? I don't usually look at natural gas in here. In fact, I rarely ever look at it. John, if you can give me the code, I'll have a quick look at it for you. And whilst you give me the code, I'm going to look at, because I don't ever look at it. It's nothing. It's a market I've never traded in my life. I do reports for the European gas in here for a client, but I don't look at it myself. Do we expect lower volatility of the market during the Fed blackout period? Potentially not, but I think on the back of that CPI, not necessarily, Jack, in here. NG, I knew that. I don't even know why I needed to ask. I knew it was NG. Why did I ask that? Is that the mini or whatever as well, John? Or is that, sorry, not John. Rob's giving it to me. John wants it. Rob's giving me it. Is that just NG, right? So is it you? Are we on the September contract? It's going to be Q. Is Q the front month? August? You're asking, John. Up to you to answer, I guess, really. Just doing it for you. What months do you want? Because there's no point in me doing it. Q. Okay. I know there's a delay in there. So, okay, let me have a quick look on Nat Gas. I'll start off on the daily. And say I'm doing this fresh because I never look at this. Right, natural gas. Well, you know what? It's come all the way back down again. This is not dissimilar to the charts that I see anyway in here. Sorry, I need to get rid of this call. Sorry, guys, should be on mute. It's not dissimilar. Obviously, falling in here, has been falling, coming back down as inflationary concerns ebb, and as the situation in Russia and Ukraine has changed throughout this year. It's similar to the European gas markets that I do look at in here. You could say that it's trying to hit a double bottom in here, or a bottoming pattern, but I don't think it is. And for me, it's kind of failed. It had the opportunity. It just ticked up here and it's fell back down. I mean, it's kind of a little bit caught in here. But going into today, I'd have to say it's slightly in the downtrend, so I'm slightly bearish. And if I'm going to go into a 15-minute chart. It's trying to hold here, right, but it's not really managing it. Yeah, bearish. I think it tried to set up as a bottoming and just failed miserably. So bearish in here. Just down through the lows. Down through the lows, John, it looks quite negative. So what have we got in here? 2616 down through there looks negative. You probably, where's the sell zone? The sell zone's in here somewhere between 2645 and 2655. There's the sell zone, and looking for it to make new lows today, I would say. Yeah, so bearish, even with the dollar week. Should be bullish with the dollar week, but it can't rally with the dollar week. All right, then. I'm going to wrap it up there. Hope that helped. I'm going to wish you all a great trading day. I'll be back with you tomorrow for the final bull versus bear webinar for the week. Until then, take care. Stay safe. Cheers, guys. Bye.